Hi guys, today we are looking at break-even analysis. Unfortunately, there will be some numbers and some calculations, so I would advise you to maybe get some pen and paper or have an Excel file ready to go. So let's start with what is break-even analysis and how it works. So break-even analysis in general is a tool that allows you to understand how your business, your profits will change depending on your volume changes. And so we need to start to understand the types of costs that you might have so that we understand how they will vary depending on how many products you are selling. And so first, let's look at the initial one is fixed and variable cost. So fixed costs are costs that do not vary with changes in the level of activity. So imagine if you have a shop or a restaurant and you are selling Italian pizza, for example. If you have 1, 2, 10 customers, your rent will stay the same. So your rent will be a fixed cost. Maybe also the CEO salary will probably be kind of a fixed cost. On the other hand, your variable cost will change. For example, variable costs are costs that vary with changes in the level of activity. So in the example of the pizza restaurant, if you're selling 1 pizza or 10 pizza, the amount of tomato sauce or the amount of flour that you need, that will change more or less linearly with the amount of activity that is increasing. So if you sell 1 pizza, it will probably cost you $1 in tomato sauce. If you sell 10 pizzas, you will pay $10 in tomato sauce. So remember, the rent doesn't change, but the cost for your tomato sauce will change. And then there will be some called semi-variable costs. So these are costs that are a mix of the two. So for example, you can think in the case of the restaurant about waiters. And so if you have 1 to 10 customers, maybe you can have 1 person working and as a waiter. But this is neither variable nor fixed because you will still need to pay the salary, full salary for that person. And so it will be fixed between 1 and 10. But then if you have more customers, you will probably need a second person. So it will be 1 to 10, one waiter, 10 to 20, second waiter, and so on. So this type of cost has a mix of the two and will be fixed up to a certain extent and then grow. We can argue that fixed costs are probably never really fixed, apart from a few cases, because even rent is not really, I mean, the restaurant space is not really fixed, because if you get 100,000 customers, probably you will need more locations. But in general, for example, real estate is considered fixed, although up to a certain extent. And so looking at the break-even analysis, once you have decided and understood how the cost can be split into different categories, the main break-even analysis is the accounting break-even. That gives you the net income before or after tax, okay? And in my case, I also added a second case, so this one in the middle, which is after tax net income. But in this case, we don't give it 0, which is the normal accounting break-even. We choose an amount of money. For example, we want to know how many products we need to sell to have after tax net income of $100,000. Okay, so the main one is the first one, and then we have developed 2 more to tell you how many products you need to sell to have a certain amount of income before or after tax. Okay, so the break-even analysis is a tool for analyzing the relationships between sales volume and profitability, and we have 3 types that we can use depending on the information you want to extract. So some basics. So the basic equation for the accounting break-even, which means that you have 0 profit. And remember, since you have 0 profit, there is no difference between before and after tax, because you only pay taxes on your profits. So if you have 0 profits, you also have 0 taxes. So the accounting break-even, you need to find at what volume your sales minus your variable cost minus your fixed cost equals to 0. So how do we do that? So the first one is sales minus variable cost represent something like a gross profit per unit. So imagine if you are selling a pizza, for example, for $10, all the variable costs inside, such as flour, water, and tomato sauce will be inside there. So for example, imagine if you sell it for $10, you have $5 in tomato sauce and other costs, your gross profit per unit is $5, okay? And the second part is that your gross profit per unit multiplied by the number of units sold will need to cover for your fixed cost in order for fixed cost to bring your overall profits to 0. I know this might be confusing, but don't worry, we will have examples that will help clarify this. Just remember that accounting break-even, which means finding the volume of products sold that gives you a 0 profit, you need to find the volume that gives sales minus variable cost minus fixed cost equals to 0. Another way to calculate this, and this is a sort of shortcut, which I like, is to simply do fixed cost here divided by gross profit per unit. So remember, we had pizza cost, you sell it for $10. You have variable costs, such as tomato sauce, for $5. So your gross profit per unit is $5. Assuming your rent is $5,000, to understand at what quantity you have a break even, you simply do $5,000 divided by 5. So you need to sell 1,000 pizza to go even. This will help you pay the rent as well as all variable costs. Anyway, more examples will come in the next slides. So for example, let's do this one. So you have a sales price per unit of $10, the same I was talking about pizza. Your cost of goods sold, or also variable cost, is $6.5. You have a number of fixed expenses, such as admin expenses, depreciation expenses, fixed interest expenses, and they are in total $320,000. Your tax rate is 30%, but this is just a sort of a trick, because again, tax rate doesn't matter when you have 0 profits. So the question is, at what volume we have an accounting break-even? And let's see how to do this. So my suggestion is you do this thing. So you look at what quantity, selling price, or you write down all these numbers that are in the previous examples, and then you can fill them up with your case. Let's see how I have done it. So I have started basically from the bottom here. So what I've done, I have calculated what is the gross profit per unit, which remember is price minus variable cost, and this is $3.50, okay, here, which is basically $10 minus $6.50. Once I have the gross profit per unit, I do the total of fixed cost, which is $320,000, as you can see from the previous slide, divided by 350, and this gives me a number which is 91,429. Once I have this number here, I put it here, and then I do $91,000 times $10 of selling price gives me total revenues of $914,000. Then I have all the variable costs, so I will do 91,000 products sold times 6.5 variable cost gives me 594,000 in total variable cost. So if I do 114 minus 594, I get a gross profit, remember the income statement, of $320,000 approximately. From this number, I reduce the fixed costs, which are also $320,000. So I get a net profit before tax of 0. Tax is 0 because there is no profit, and so the net profit after tax is approximately 0. I hope this example clarifies. Let's start again. You start by saying what is my gross profit per unit, which is $10 price minus 650 variable cost, so 350. Then I do fixed cost divided by 350, and this is the volume I need to sell to go and have an accounting break-even. Then I simply do the multiplication, number of products times price, number of products times variable cost. Then I do revenues minus variable cost. I get 320,000 in gross profit. I reduce the fixed cost and I get 0. Again, we'll have some more examples that you can do at home. Try to see, to do this without watching the video. I'll give another solution, and then there will be an exercise that you can do by yourself. So in this case, it's basically the same information. You have sales price unit for $15, cost of goods sold for $5. Then we have 3 types of fixed expense, and again, the tax rate. The question is, at what volume, how many products I need to sell to have an accounting break-even? So we do the exact same thing. In this case, I already solved it for you. So what I've done is, first, gross profit per unit of $10, which is 15 minus 5. And then I do total number of fixed costs, which is 400,000. I do 400,000 divided by 10, which is gross profit per unit. I will need to sell 40,000 products to go and have an accounting break-even. I put 40,000 here, times 15, 600,000, 40,000 times 5, 200,000 in variable cost. The difference between 600 and 200 is 400, which is exactly what we need to cover the fixed cost, and therefore our profit is 0. So this type of calculation is useful for you to understand how your business is structured. For example, it might help you to think, do I want a bigger restaurant? This will increase my variable cost, my fixed cost. So how many more pizza do I need to sell to go and break even? So this helps you in your financing decisions, and also helps you to give a sort of indication on how big your business needs to be. So for example, if you are opening a restaurant in a small town with 5,000 people, and you see that you need to sell 500 dinners a day to have a break-even, maybe you are being too optimistic and you need to reduce your cost. Maybe go for a cheaper real estate, for a cheaper location. So this is how this works. As an exercise, there's another example here. Let's go back. So here you have exactly the same thing, but here we are looking at the profit before tax of $100,000, right? So the previous example was asking you at what volume I have a profit of 0. This is the second type. Before we mentioned there are 3 types. This is the second type. At what volume we have a profit of 100,000 before tax. So how does this work? This is basically the same thing as before, but instead of just having a volume that covers enough of your fixed cost, you need to add the profit before tax that you want to generate. So you can see that here I have 400,000 in fixed cost, but in the end I use 500,000, which is 400,000 plus the 100,000 profits I want. So you do exactly the same thing. You do $15 selling price minus $5 variable cost per unit, so the gross profit per unit is 10. And then I do 500,000 divided by 10. I need to sell 50,000, for example, pizza, to have a profit before tax of 100,000. So I put 50,000 here. 50,000 times $15 in selling price gives me 750,000 in revenues. 50,000 times 5 is $250,000 in variable cost. The difference between this and this is 500,000. From this, I need to reduce all my fixed costs, which is 100,000 and 300,000. So my profit before tax is 500,000 minus all this, which is 400. I get 100,000 profit before tax. In this case, I have a tax because there is a profit. At 30%, I generate $30,000 in taxes. And therefore, my net profit after tax is 100 minus 30, equal to 70,000. So this, again, is an accounting break-even modification. This tells you how many products you need to sell to generate a certain amount of profit before tax. After tax would be different. And to do this, you just need to add the profit before tax to the fixed cost, and then the calculation is exactly the same. As an home exercise, try to understand in this example at what volume we have a profit before tax of $200,000. In this case, you don't need to look at the non-discretionary capital expenditure because this is a cost that is not included in this calculation. So follow exactly the same steps we have done before and trying to understand at what volume we need, how many products we need to sell to get a profit before tax of 200,000. The calculation will change if we want a profit after tax of $200,000. Because in this case, what we need to do is understand how much tax we would be paying to have a profit of 200,000. Okay? And so the calculation for this is basically following this formula. You want a 200,000 profit after tax, and on this you will need to pay taxes equal to 1 divided by 1 minus tax rate. If tax rate is 30%, this is 0.3, so it is 1 divided by 0.7, which is equal to 1.4285. So in order to have a profit after tax of 200,000, we need to do a profit before tax of 285,714, which is 200,000 times this. This will equal 200,000 profit after tax, on which we will have paid $85,000 in taxes. Let's see how this works. It is exactly the same calculation. If you generate a profit before tax of 30%, you will pay $85,000 in taxes. So after tax will be $200,000. I know that this sounds a little bit complex, but all you need to remember is profit before tax times 1 divided by 1 minus tax rate, which in this case is 30%. So let's see the example that we mentioned before. So we had a $15 selling price and a $5 variable cost per unit. So in this case, again, the gross profit per unit is 15 minus 5 equals 10, and we put it here. The fixed costs are 400,000, to which we add the $250,000 that we have found here. So remember, here we have $285,000 that we add here. So we want the net profit before tax of $285,000. And so to do this, we have $685,000 divided by 10. Means that we need to sell 68,571 products in order to have a 200,000 profit after tax. Let's try to put this 68,000. We put it here, times 15 is approximately $1 million in revenues. This times 5 is $340,000 in variable cost, which gives us a gross profit of $685,000. We reduce the 400,000 in fixed cost, which means that we get a 285,000 in net profit before tax. We pay 85,000 in taxes. Our final number is what we wanted, which is a net profit after tax of $200,000.